Hi, this is Ralph Russell. Thanks for checking out Borrower U. On today's episode, we're going to be joined by David Hulit. David is one of the smartest SBA guys I know. He is a business development officer for Port 51 Funding, and we're glad to have him on today's episode. For future episodes, any topic you want me to cover regarding commercial real estate, investment rentals, or business lending in general, feel free to leave in the comments section below. I'll be happy to cover any topic that you'd like me to bring to the table here on Borrower U. So let's get into today's conversation with David Hewlett.
The SBA 7A loan is kind of the Swiss Army knife of the loan products. There's other loans like the 504 loan, really commercial real estate and equipment focused. The SBA 7A loan is going to be for everything, really. It's going to be for commercial real estate, working capital, equipment, startups use it. It's for financing changes of ownership, business acquisitions, partner buyouts, debt consolidations. It's really the jack of all trades. So most people who come to me, I work with individuals like Ralph nationwide, and we're primarily focusing on, owner occupied commercial real estate. Think a restaurant that's been leasing their building. They've got the opportunity to buy that building. We can do those with as little as $0 down. That's one of the big appeals of the SBA 7A product, is you can buy a building for an existing business with no money down. It's very hard to even buy a house with no money down,
No
let
doubt.
alone
Yeah.
let alone a commercial property. So that's one of the nice advantages of that.
I want to come back to that zero money down financing, or if I just say 100% financing, but many other things to hit on first. So what type of credit does someone need to qualify for an SBA loan?
Technically, there's no minimum. It's common misconception. Now you'll find banks have their own minimums, and they may say that that is the SBA's minimum, but there is no minimum with the SBA, generally speaking. Now there's what's called scored loans, and those are loans 500,000 and less. Just because the loan doesn't score doesn't mean it can't be done. And then loans 500,000 or more don't get scored, and it's really up to the lender to decide. So lenders are going to look at all the elements of the deal. Like, I've seen deals get funded with 600 credit. I've seen deals get funded with 590 credit. But it's going to all be a balance of, what's the credit score? What's the cash flow? What's the collateral? What's the story? Was there a good reason that the credit's low? Or is it somebody who habitually doesn't pay their bills? So sometimes there's a period of time where maybe someone went through a divorce, something traumatic happened in their family, a unique one-time event that knocked down their credit score. Other times you can look and there's a pattern. So that's how a lender's going to look at it. Some lenders will look closer than other lenders. A lot of lenders have arbitrary cutoffs, 680, 650, 600, etc.
So a lot of common complaints, I guess, if you will, about the SBA loans I've heard from borrowers is, I would consider an SBA loan, but the process takes too long. Now, you and I both know that a lot of the timeline from getting an SBA loan looked at and reviewed is how organized is a borrower? Do they have all their financials together? Meaning, and we'll get into this briefly, we don't have to go on about it too much, but do they have 3 years of business tax returns available, 3 years of personal returns available? Do they have something called a debt schedule available where it lists all of the business loans? Do they have a personal financial report? And if they don't have a personal financial statement and we send them a blank copy, well, they turn it around within a day or two, So you and
Yeah.
I both understand, look, at a lot of the delays for these kind of loans is because the borrowers are not organized, or they say they're going to get documents back on a timely basis, or they don't. But for the viewer's sake, how long does it typically take to get a deal done with you guys?
Yeah, I mean, it's a great question, and there's no one answer to that question. I've closed business acquisition loans from receipt of the very first document, very first conversation, since inception, to closing and funding in 33 days.
Wow.
I've closed a real estate acquisition in 29 days. I've closed a business acquisition in 25 days. I've also seen deals take 18 months to close. And the common denominator is the borrower, the seller, the CPAs and the attorneys. I like to say I can move as fast as you can move. If I give you a checklist of 20 items and I get all 20 items back within 12 hours, you're going to be one of those 33-day closes. But if I
Mhm.
send out a checklist and I ask for a personal financial statement and it takes you 2 weeks to provide it, and you still didn't provide the other documents, I can only move to the next stage once, generally speaking, 90 to 95% of that list is provided. Our team can underwrite a deal in 5 to 7 to 10 business days, depending on complexity. Complexity looks like, are you one business owner with one business, or are you 5 business owners with 10 businesses? That makes the deal more complicated to underwrite. So each individual situation is going to be unique.
How
Yeah.
often do you need collateral to get deals done? Let's start with that.
Yeah, I like to, when I talk to a borrower initially, I like to say, like, let's talk about the reasons you don't want to take this loan. Let's rip the
Right.
Band-Aid off. And so number one reason that I see people not take an SBA loan is the collateral requirements. Um, you know, if you're buying a business or if you're taking a working capital loan or if you're doing something that doesn't inherently include collateral, i.e. buying a
Mhm.
building or buying equipment, or if you're doing very high leverage acquisitions, the SBA has a rule that lenders must take all available collateral to fully secure the loan. What that means, it's a little complicated, but this is what it is. So if you, for example, the only place that this doesn't apply is Texas. They're very unique and very lucky. They're what's called a homestead state. But
Mhm.
all other 49 states, if you own a home or an investment property or other collateral where you're the 100% owner, or it's you and your spouse are the 100% owners, it is required to be pledged as collateral to fully secure the loan. So if you're looking for $1 million loan, for working capital, for instance. This is a hard rule. Can't change it. Lenders have no say in it. That if you have a house that's worth $1 million and it's free and clear, which means there's no mortgage on it, that means that house needs to be taken as collateral. Now, the SBA has some flexibility if there's less than 25% equity available. So let's say you own $1 million home and you have a $900,000 mortgage. Technically, that does not need to be pledged as collateral. A lender may want to take it anyways, a lender may not. But that's when it becomes, you've got two bosses really. You've got the SBA and then you got the lender's credit box. There's what the SBA requires all lenders to do, and then there's what the credit box of that individual lender's institution is going to apply on top of that. But that's the kind of the rule of thumb is if you have greater than 25% equity available in your home, it's required to be pledged as collateral to fully secure the loan.
Now, personal guarantees, there's a lot of people that get hung up on a personal guarantee. And can you explain to the audience what a personal guarantee is and why it's required in
Yeah, the
SBA case?
personal guarantee, a easy way I like to think about it is a lot of people are familiar with student loans. It's a government guaranteed loan. It's a loan that is with you forever. And so it's similar with the personal guarantee. It's a government guaranteed loan program. That personal guarantee is not to me, the lender, not to
Mhm.
my institution. That's to the government. That's to the IRS, or that's to the tax. That's to the taxpayers, really, to
Mhm.
us, all to the borrower themselves. It's the Treasury will collect on that indefinitely. It's a very serious thing, and the reason why is you know we have to be prudent lenders. If we're giving people money that's backed by government guarantees, we need to make sure that the borrowers are all in.
Mhm.
If the
No
government's going to
doubt.
back it, if our tax dollars are going to back it, they need to know that borrower is fully committed, and that's why. And a lot of the times these loans don't have collateral. So back to your question before about is collateral required? An interesting thing is if you're a renter and you want to get a $5 million loan to buy a business, you don't have collateral, you can still buy that business, which is great.
Mhm.
You don't have to own a home. You don't have to have a building. But if you do have it, you have to pledge it as collateral. That's the rule. The-
Um, So David, talk to us about prepayment penalties with SBA loans.
yeah, great question. So the 7A program, if it's a 10-year term, actually, if it's less than 15 years, but realistically, you're only going to see it in 10-year or less terms. there's no prepayment penalty. So if you're buying a business without real estate, you're getting working capital, you're buying some equipment, no prepayment penalty. Theoretically, you could go refinance that loan 2 days later. I don't know why you would do that. And if you got a loan from
Mhm.
me, I'd ask you not to do that because it's a waste of my time.
Mhm.
But
Right.
you could do
Yeah.
it. Now a real estate loan, 25-year term, and that's 300 months. That is a loan. And then really you could do it with a 20-year term as well. That's going to have a prepayment penalty. And that's going to be 5% the first year, 3% the second year, 1% the third year. So it's a 3-year prepayment penalty. It declines each year. You can make some early payment on it. I believe off the top of my head, it's 25% that you can prepay without incurring the prepayment penalty. And we see this quite a bit where somebody may, be a newer business, or they're buying a piece of real estate on projections, and that's where SBA is a very good fit. It's not a good fit for conventional. Maybe they need to do 100% financing, projections based loan. Great application of 7A, and they're going to buy it and they're going to stabilize and they're going to have cash flow year 2, year 3, right? And in that instance, by year 4, they've had cash flow in year 2 and 3. By year 4, once the prepayment penalty is gone, they're cash flowing, they're stabilized. Great candidate for a conventional loan. So a lot of people use the SBA 7A loan in particular for real estate as a
Mhm.
transitional loan product. It is not, and you'll probably ask this question later, but it's a good time to segue into it, is because the interest rates that are most commonly seen with
Mhm.
SBA 7A products. Most commonly, the vast majority of 7A loans are adjustable rates.
Mhm.
And a lot of borrowers, especially new business owners, are coming out of a world where they're used to fixed rates. There's fixed rates on their homes, there's fixed rates on their cars, etc. In vast majority of national SBA 7A lending is going to be adjustable rates, and it's based off the prime rate. And the prime rate is 7.5% today, and that
Mhm.
goes up and down based on the Fed funds rate. And the Federal Reserve will come out and they will say if they're keeping the rates the same, if they're raising them, or if they're lowering them, and that'll impact your loan. And there's a spread on top of that rate, so it's not just the prime rate. It's usually prime plus a certain number, up
Mhm.
to a maximum of 3% for loans over 500,000. Loans under 500,000 have some different pricing maximums, but a loan from 500,000 to 5 million, the maximum you could be ever charged is prime plus 3%. Today, that's 10.5%. You're going to see everything from prime minus 1% in the market to prime plus 3, everywhere in between. And certain factors are going to dictate what your interest rate's going to be. If it's projections based, if you have a low credit score, if you have low money into the deal, if you're in a risky industry, all these things are going to impact what your credit scores or what your interest rate is going to be. And so that is how that methodology is put into place. And so when somebody does a projections based loan to buy a building with 0% down, they're usually going to have a higher interest rate. So they might be at prime plus 275,
Mhm.
which is 10.25%. And many people might hear that rate and think, wow, that's a lot. Also,
Mhm.
you leaned up my house because
Right.
if you're, because it's such a high LTV, they require to lean on my house. So I've signed a personal guarantee. I pledged to lean on my home, and I've got a 10 and a quarter interest rate. Wow. But you may have a 600 credit score, your business doesn't cash flow, and you got a building that's worth $3 million dollars with no money out of pocket. It's the trade off for that moment in your business's history. After 3 years, you resolve your credit problems, you build equity, you build cash flow. You're a perfect candidate to then go get a conventional loan,
Yeah.
refinance the building, and now you're onto your next stage of next chapter of your financing life cycle.
And to think that you could buy a building with no money down, a commercial building, which are not inexpensive, is really amazing. I think the majority of people don't even know there's a possibility, under the right circumstances. One question I get a lot too, and then we'll wind it up here, is, startup loans. I mean, a lot of people ask me, can I get a loan for my startup? And I read that you can get SBA loans for startups, but in my own personal experience, I haven't seen a lot of success with that. And what's your take on SBA loans for startups?
It's a great question. So I've done some. Some, but it's not super common. And, some lenders are going to have different appetites for it, and not all startups are created the same. So
Sure.
there's franchise startups. For example, if you're buying into a franchise concept like Five Guys or Jersey Mike's, right? There's a proven business model, and that startup is easier to lend into. It depends on how strong the franchise is, the quality of their franchise disclosure document, the information that's available within that to benchmark projections, but lenders are going to be more inclined to do that type of startup. There's certain lenders that do lots of those loans for startup franchises. Now, when you are in the independent startup, I'm an
Mhm.
entrepreneur, I've got a brilliant idea, but I just need somebody to give me $1 million to do it.
Right.
No
Right.
one's done it before.
Yeah.
There's no proof of concept, but I'm sure it's going to work. That's a tough bet.
Well, this has been super informative, and I don't want to keep you more than we have. So thanks for your time. We'll definitely have you back on again. Again, Borrower U is exactly for this reason. I mean, David has given all of you a lot of great insight of what goes into the SBA loan process, what type of SBA loans are available for lenders to consider. And I definitely will look forward to having you chat about some other aspects about the SBA loans and further videos. Now, again, we're joined by David Hulit. He is the Director of Business Development for Port 51 Funding, a top 25 national SBA lender. You're watching Borrower U with Ralph Russell every single week. I'll be on with great insight from lenders like David, covering all different topics. Last week was bridge loans, today's SBA loans, and each week we'll delve into some other areas I think, well, questions, frankly, I get from a lot of borrowers that I want to provide answers to. So please do consider tuning in each and every week, subscribing, hitting the like button so you know when a new video is up. And please do share with other business owners and real estate owners that you think might find this valuable. So David, again, thanks for all your time, continued success. Look forward to closing some deals we have in the pipeline together and having a great year together and many more. So best to you and your family. And thanks for your time today. Appreciate it.
Thank you so much, Ralph. Have a great one.